Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a financial mediator and business valuation expert in St. Louis, Missouri. I'm speaking today with Jeff Condren, an advisor to family business owners in Chicagoland area, and he focuses on transitions to the next generation and basically establishing a team to make the transition successful. Today, we're going to discuss an interesting topic, how valuation decisions actually shape the family wealth dynamic and system. And welcome, Jeff, to the podcast. How are you doing today?
Good. Thanks for having me. I'm very excited to be here.
Yeah, this is awesome. Maybe we should kind of set up a little bit about how you work with families and not only these business transitions, which is going to be the focus of our discussion, but also like it affects the portfolio, right? Like a lot of times the business is the largest asset of a family's portfolio. Correct. And it's sometimes something that advisors are shifting to the side and not really focus on, right? So how do you deal with some of these
There's a lot of people. Yeah, so there's a lot of people in our industry who want to focus solely on that investment portfolio because that's what they can see, that's what they can touch, that's what their knowledge is. But as you alluded to, right, the business itself is likely the largest asset they have. And with that comes a lot of risk, right? You know there's risk if you work for a publicly traded company, hold a lot of the publicly traded stock, same sort of thing with a private business. Hey, this is a business that is worth a lot of money, pays my bills, is setting my family and hopefully generations up to come. So with my portfolio, for a lot of clients, they say, hey, listen, I take a lot of risk over here. With the business, decisions being made, expansions, hiring, those sorts of decisions. Over here with the investment portfolio, I don't want to take those types of risks. I don't want to wake up and hear the market's down X and my portfolio is down Y because of it, right? I need to balance the risk between the two, knowing that one is very easily changed in the market. Basically, every day the stock market open, the bond market's open. I can make changes in something where I can't necessarily make those same changes day in, day out, or week to week even. Some of these changes may take months or years to actually implement. So finding that balance between those two is often a conversation that needs to be had with business owners.
Well, and that's interesting because I would have assumed that they were risky, like if they were risky in one area, they would be risky in all the areas. But I think what business owners and family business owners are seeing more risk in is transitioning to the next generation. Like it feels like these business owners are holding on longer. They're not really seeing, and they may not even know the benefit of even gifting shares or estate planning or strategic planning. How do you start to have that conversation with them when most business owners want to keep their company forever, right?
Yeah. So some of the most successful business owners are the ones most reluctant to sell because this has been their baby for before they got married and before they had kids potentially. So this is something that's been a part of their lives for so long that they have a hard time discussing doing anything than what is status quo, which is keeping the business running, keeping the business going. So then from there, it's really a conversation of there's kind of like different stages almost of, does it make sense to get it to the next generation? And we don't start there. We start with, hey, if you were approached today and someone wanted to buy your business, are you prepared to have a realistic number? For some business owners, they're good about it, but for vast majority, they're not because they don't have that, it's the end of 2025. I haven't had a business valuation done in 2 or 3, 4 or 5 years. I should probably do that because a lot's probably changed since, let's just go back to 2020. A lot's changed in these 5 years. They may not have actually reevaluated things. The generic, if a competitor came up to you from another market and said, hey, we're interested in buying your company, you want to have at least a somewhat realistic number. And what we've seen is that when you are too optimistic and overvalue your company because you have a lot of emotions tied to it. Hey, I built this. It's been a part of my life. That sometimes will stall the conversation. And on the reverse side, if you undervalue it, you're like, oh, well, man, I don't think this is worth that much. Like it's paid my bills, it's done this, but really there's a lot of value to it. Those things will kind of stall the deals and maybe never advance it past that initial conversation. So doing kind of regular business valuations actually is one of the first steps to knowing that you will have a realistic valuation for a buyer to come in. And even if the buyer is that next generation, that hey, this is what the business is worth and this is where we're going from here.
Yeah. And I think that that's a great question, because I think it gets people thinking because they're not thinking of selling, right? So that's usually not an issue. But if you ask them, if your approach to sell the business, are you ready? It starts to get them to think like you can't be approached today and then know what the number is. Like a business valuation takes a little bit of time. Assembling a team takes a little bit of time. Even sometimes cleaning off your books, getting everything in order. If this is a family held business or family run business and you have half of your team is, also family, then this is a lot of the issues that may not lead to transition. And as well as, in some capacity, they're assuming maybe or hoping that there are other family members that are going to come in and they're going to transition this business. Like, well, my children weren't the ones, but now I got some grandchildren and they're just entering college, right? So if I could just hold out for them to get, and I'll see if they want to own run the business. So what are you seeing? Because I see a lot of business owners that are kind of right on the fence of like, okay, well, I don't know if I want to sell it because I'm waiting for these next generations, yet somebody's coming, yet I need to have this major asset become part of my retirement portfolio, right? And so we encourage people to do a business valuation because you could at least know what that number is when somebody approaches you. Like if somebody approaches you and says, well, what would you sell the business for? And you say, oh, you know what? Strategically, every year we get a valuation and it's $10 million. Then, and the person will be like, oh, I thought maybe 5 million. Well, you're not the right buyer. Thank you. Thanks for hanging out. I'm waiting for the next generation. But do you see families waiting for generations or really proactively planning, maybe some gifting or maybe some, getting their books ready to eventually sell? Like, what do you see people really doing?
The vast majority kind of take a passive approach, which is I'm here to keep the business running. I'm not here strategically looking at the bigger picture of what this business could be if I were to sell it in 5 years or 10 years. They're thinking like I need to make this decision on if we're going to expand in 2026 or not. I need to make the decision if we're going to make these key hires, make these key salespeople, what that's going to be. They're not thinking, hey, the business is worth 10 million. And if someone approached me, I can also back it up and explain why it's worth 10 million. And I can show, we can get into NDAs and say, hey, here's all of our numbers to show you why it's worth that 10. So if someone was surprised, oh, I thought it was only gonna be worth 5. Well, here's our proof. But that goes back to knowing the numbers and being ready in the beginning. If you're unrealistic in the beginning and you say 10 and they say 5 and you just go, okay, it's 5, but really it was 10, you just left $5 million on the table because you just weren't prepared. And it's simple conversations. Now, as far as thinking ahead and looking ahead, right, it is some of that, having the right partners, both internally and externally. We call them accountability partners, right? Who is kind of that management team that you have, whether they're family members or not, that are helping run the business, but who's outside of that business that's also helping you, whether it's the attorney who helped set up the business. Say if it's a more recent company in the last 5 or 10 years, maybe you still have a regular relationship with that attorney. How it's set up might be of interest or a preference to a buyer. If you're an S Corp, C Corp, partnership, those are all going to have separate little things. But again, being able to say why the business is worth 10, what you can do, and do assets like cash need to be distributed to internal people before a sale, after a sale, but also those external partners, right? You have someone internally saying, hey, we've done our books. We do it every year. It's worth 10 million. Maybe once every 5 years, 10 years, bring in an external auditor, a CPA of some kind to say, yeah, hey, we're just going to give a cursory review. We're going to make sure that what you're saying is true. And then we'll give our seal on it as well. Because then not only do you have that internal, you have that external one to say, hey, listen, this company, this big 4 company or one of the accounting firms validated all of our numbers. So it's not just us saying it's worth it. It's a third party firm as well. And then you take a likes of myself, a financial advisor or an estate planner to come in and say, great, you are going to sell. It's going to be $10 million. What's next now, right? And we know the sale is not going to happen at the end of 2025 unless it's been planned for, but then what? Are you staying on with the company to continue the operations for 2 or 3 years? Is it just you as the owner? Is it you and the management team? Now that you have this money, are you looking to pay for children and grandchildren expenses, weddings, colleges, homes, those sorts of things? Are you looking to become charitable, whether a university, a high school, other nonprofits? Those kind of conversations start to come up because it's like, well, now what am I going to do? I've been running this business, and let's say you do a full out sale and now you're done. Then what? And that sometimes catches people too, as much as getting the number. I feel like, well, I don't know what I'm going to do once I sell this business. So I'd rather just stay running the business because I don't know what else I'm going to do, right? I don't have the hobbies. I don't have maybe they're at the country club, but they're doing it for social reasons, not because they enjoy it. They want to keep running the business because that's what they've known.
Well, and the business really, for most business owners, the business becomes their personality. It becomes their life. And what we see is that people are really holding on to, I'm just going to continue to operate. I'm going to continue to grow it. I usually have derived a lot of wealth from running this business over time. There also seems to be this thought that there's never enough, right? Even if I have this property and this wealth, I'm not going to survive through retirement. It's not enough. So how are you handling some of those conversations? Because, sometimes the transition, if it is internal and you're gifting some of those shares, you're not going to receive that big windfall of money from the business, right? And so you'll need like an employee agreement or a management consulting agreement, or, receive rents from the property that they're leasing or the building, hold back the real estate. Like how are your discussions centering around, is there enough? And do you see that conversation that, we're still in this sort of, scarcity mindset of like, I don't know if I have enough to retire. And what if I become disabled or need like long-term care? Like, how are you approaching that if there's a transition that doesn't equate to a $5 or $10 million sale?
Yeah. So some of this is very generational, I would say. So I would say, especially if they are the firstborn child and their parents were of the Depression era, that never enough is, I hear constantly, because what they saw when they were growing up as kids is their parents struggling to put food on the table, basically, right? There was a time where there's a lot of stuff we take for granted that now they saw their parents struggle. They built this business, empire, if you will. And it doesn't matter what that number is, 5, 10, 15, we could get to 50. It is that feeling of it's never enough because they saw their parents struggle basically till their deathbed. So it is a conversation, and you have to meet them with where they're at. There are some that are hard-nosed that it does not matter how many times I show them what a sale would do for their assets, what they could do with it, how they could help their family, how they could help their retirement. If their long-term care needs were X, it's still not enough. But setting that plan up and saying, okay, hey, in 2027, we sell for X. We're going to account for taxes. We're going to account for some gifting. We're going to count. This is what your numbers look like going forward. It helps. It doesn't always solve it because the first time you show it, they don't believe the numbers. They sit there and go, well, that's not right. Or you haven't thought about this. It's like, great. Now you're starting to believe the numbers because now you're questioning it. And now you have it might be 1 to 10% of a buy-in, but now you've started to buy into the fact that, hey, this business is worth this amount because now I'm looking at things going, well, I need to account for this. I need to account for that. Well, the company paid for my car. I've run it through the business. Now I'm going to have to buy a new car. Okay, great. How often are we buying cars? Are we buying or leasing? Oh, well, I ran this through the company, or I did that through okay, great. Are you going to continue to do that? Is that an expense that ends? I never got to travel when I owned the business the way I wanted to. Great. Let's add in some expenses for travel. Are you going just you and your spouse? Are you going with the kids and the grandkids? Is this an every year trip? Is this a 5-year trip? It starts to open them up. And I would say after probably half a dozen to a dozen of these meetings over a few years, then they really start to open up with, oh, I guess that number is real. I guess that is something I can be comfortable with. But the first time you show them that number, they go, that's wrong, that's wrong, that's wrong. You didn't account for this. And you're like, great, because now I got your buy-in on what to do with these numbers.
Yeah, and I think it's a process, because again, they can take the family on these great trips every year. And it's, like I think we underestimate the emotional attachment to the business and to the transition, because even if you're transitioning the business, do you really have to leave the office? Like, I want the office, I want the health insurance, I want the perquisites, I want my credit card to be able to go have lunches and things like that. And so that can usually continue in a family transfer. But if you're selling, there's going to be this finality of the business legacy, right?
Correct.
And there is a lot around the legacy of the business, right?
Yeah, absolutely. And I think that's some of the conversation of it's where are my needs going to be met? How am I going to afford this going forward? And then it comes back to the portfolio a little bit, which is, okay, great. Let's look at what we're getting. Let's look at how it's being allocated. What are you hanging on to? What needs do you want from the portfolio? And then again, going back to kind of the beginning of how conservative, how risky are we being with things? Then it's a conversation of, do we need to take on more risk? Is getting fixed income type returns, I'd say low single digits in today's environment, kind of that 3.5 to 4.5% range. Is that enough to meet your needs? Is the portfolio just able to grow enough that your distribution won't impact the principal of the sale? It kind of goes back to some of those conversations. And again, are we gifting, whether to children, to charities, kind of helps answer some of those questions.
Yeah, absolutely. And I think that going back to, you talked about like, who are your accountability partners? And one thing that we're seeing in these complex, because this is the reality, like family businesses are not just going to market and selling, right? Unless there's like a health event, which means you're almost a little too late to get like all the money out of the business. So you either have to have a proactive plan of, you're going to sell or transition in 5 years. You're going to take as much money out that you can for the next 5 years, but then you're going to eventually sell, or you're going to transition in an estate matter, which means you're going to gift these shares to the next generation in part, or transition and, sell them back to the company in some capacity. But when we're looking at this, there are legal issues. There are accounting, like nobody wants to pay taxes. So we want to do it in the most tax advantaged way for everyone involved. They don't want to burden their family. They don't want to burden the company. But then there's also valuation issues. There's also, potentially investment issues when you have the money coming in. And we have seen, and I think you can talk towards it, that this is a time, at least once a year, maybe even twice a year, to bring all of these people together so that we're saying, hey, are we going to have a tax issue? Hey, are we going to have a legal issue? Like, how do we make it so that, and when you bring them all to the table in a concerted effort, you then are not going to do something that legally messed up things, accounting messed up things. But who are these accountability partners that you want to see at the table, regardless of the transition, right?
Yeah, absolutely. So on the business side, it starts with kind of that treasurer, CFO type role, depending on the business, whoever they have, right? They're likely going to know the numbers better than sometimes the business owner themselves. So we need to see them at the table so they can walk through, hey, here's where we're at, or here's what we're projecting to be, here's what we think next year could be, those sorts of things. If they have any sort of external accounting auditor of any kind, that's also fantastic to kind of, again, validate that, hey, these are real, we're not seeing any issues or risks to the business that someone could access cash in some way or shape or form. The broader management team, I think if we get to the point where we're actually considering selling, then you can bring in some of those other key stakeholders, whether it's a marketing person, whether it's a chief operating person, to say, hey, listen, we're potentially going down this path. Here's what it means for the broader team. If we do, is it a payout? Is it they want to keep everyone at their salaries and then maybe plus some, but not necessarily the first meeting if we're kind of having this discussion. Usually it's a little bit more down the line. But then some of those external partners I was mentioning, obviously the external accounting, CPA, auditor is helpful. A financial advisor and an estate planner, especially for two different reasons. one, not to lead necessarily the business valuation side of it to say, hey, the business is worth X and we're going to get it. But then, okay, we agree the business is going to sell for $10 million. Okay, business owner, you're getting X amount of it. Let's just say 7 million of the 10. Great. Have the business side of the people leave. Hey, business owner, what are you now looking to do? Because when this 7 million comes in, it's day one, we have $7 million. It's not likely that it's going to trickle in unless there's some kind of agreement where there's a 3-year, 5-year payout type thing. But hey, day one, we're going to get a wire for $7 million, or you're going to get a wire to your bank for $7 million. What are you looking to do? What are the plans for it? A lot of these conversations need to take 1 to 2 years a minimum before I feel like everyone's kind of on the same page on what's going to happen, and all the right structures can be in place, whether you need a trust for your self and your spouse, whether you want trust for kids and grandkids, if you're looking to do what's called a donor advised fund, if you want to be charitable and get that donation in, right? These are conversations where you shouldn't just make a knee-jerk reaction and go, oh, I got $7 million. I need a foundation. I need a trust right away. You may not, depending on what you're looking to do, or depending on what your needs are and what the family's issues are or aren't, if you will. But having those conversations over a few different time periods help kind of bring out any issues that, hey, look, I thought I wanted to do this after talking about with my spouse, after talking about with my kids. I think we want to do this instead. Okay, great. I'm glad we didn't just jump into things and then do this. So a year to 2 is kind of what I like to see as kind of like a minimum before we actually go to sell. And then that will allow us to then say, hey, looking ahead, are there estate issues that are going on, right? Earlier this year, we didn't know what was going to be as part of the One Big Beautiful Bill Act as far as estate planning. Would those estate planning thresholds drop? Would they stay the same? Would they go higher? So we were talking with business owners like, hey, listen, we don't know the answers now. When we do, we should meet to see if this changes your decisions and what you're looking to do in the future.
Yeah. And I think that it should make business owners feel more comfortable about the fact that this is a multi-year process. Like, this isn't a make a decision today. This is start to figure out like what, like even start to envision what you would do with the money. Would you travel? Would you take the family on trips? Would you, start to donate to things that you love? Either former college institutions or educate, like whatever your passion is. I think it starts to get them to understand that there is life after this business.
Right.
But what we're seeing is that we're coming in to mediate a lot of family issues, right? Where there's multiple siblings, there's multiple business interests, there's a lot of land and real estate. And we see that the parents have this burden of, we've created this massive wealth. We have been blessed, right? We've created businesses that our children are running. We did have this background of a little bit of money trauma from, our family. And we don't know how, like, we're burdened with these decisions of what to do. Yet part of this is, how do you incorporate the next generation? And, I'm seeing that having these discussions at random family dinners, right? At the holidays. Well, we eventually need to transition this business. And you have these children or grandchildren who are basically in control of the businesses and running them, but they are not from a strategic standpoint, actually owners of the business or even controlling owners, right? So you start to have this it almost creates this chasm of issues, because we have people that are in control of the businesses, but we have the parents that are in control of the shares, and they're both burdened by these decisions. We've seen that it's been more helpful to start to gently pull them. And again, this is a multi-step process, but to gently start to build them in. Sometimes the children and management team are not even aware of the full financial situation or picture, because the parents have kind of held that close in these smaller towns or these smaller communities, right? So how do you see incorporating the next generation as, not only beneficial for the transfer, but you start to disseminate some of the information, right? In a slower way. It is sort of opening up, all of this very private information to all of these advisors and the next generation. But how important do you see that in the process?
It's crucial, right? And I think when I get introduced to a new family-run business, once we've done kind of introductory stuff and we actually get talking about things, one of the questions I ask is, when did you expose the realities of the business to the next generation? And you just kind of stop and let them take that in. They go, well, what do you mean? I go, was this a son, daughter went to college and you knew after college they were going to come into the business, and so they did right away? And so they've been a part of it for 10, 15, 20 years now. So they have an understanding of how the business is run and what's going on. Or did they go do something else for post-college, 10, 15, 20 years, now come back and expect to be the new owner, right? Do they know everything that's gone on in the business? So when did you expose the realities of running this business to your children? And for some, it's still like, I haven't. It's like, okay, well, again, let's talk about what that means then, right? Let's get to the values and expectations of this business and what it means to you as business owner, as parents to these next generation, and also to your employees, right? There's an business owners I've dealt with feel a moral obligation to both, right? I've built this great business. I have been blessed. I've set my children and the next generation after them up, but I've also hired all these people. They depend on me for this business. So they feel this need of, I wanted to take both. So clarifying the values and the expectations, both from a family and a business standpoint, is crucial. And I can't tell them what their values are. I need them to say, here's what we value and here's our expectations, both from both sides of it. Which needs to be a multi-step discussion. It's not a one conversation, 1 hour meeting, at the holiday dinner kind of thing, right? And the other thing we always kind of talk about is fair doesn't mean equal and equal doesn't mean fair. So if one child came in out of college, has been running the business for 20 years, one child decided not to run the business, go do something else completely different. Not to say that you couldn't sell the business and do 50-50 and go here, but the parent might say, hey, I want to take care of this one and have them run the business and have them look at the business and go, hey, this is going to continue to appreciate, so we're going to do a little more for this other child, or vice versa. Hey, this one's now set up for life. They're going to be able to continue things. We're going to do something else over here that's completely different, right? It in the parent's eyes, it might be fair. It's not necessarily going to be equal. But then again, don't let this be a one-time conversation with the children, especially if there's multiple, because it might be a mess while you're alive, and it might be a hard discussion, and it might be years of it. Unfortunately, it'll only be worse if you pass this mess on and there's no clear expectations and there's no clear values on what you want done, right? After a death, especially of a business owner, if the spouse isn't involved with running the business, that's when it's the most complicated, complex. No, the emotions are higher because now there's been the death of the family. That's worse than having it while you're around and continue to talk about it.
Yeah. And I think when you're transitioning a family business to the next generation, clear communication, when you're deciding things, that you have actionable items, you're not talking about something and then 5 years later, you still haven't transitioned the business, looking at multiple siblings and saying, well, maybe I can transfer the building to one child that's more in a passive role and the company to another child, not just gifting so that everybody is now, 4 siblings or 25% owners, right, and nobody's in control. Because again, if you bring in the lawyer and the business valuation expert and the financial advisor and all these consultants, they're going to tell you that these are what breaks the family after you leave. These are the things that we're coming in litigation because, we have minority interest lawsuits because, they're not distributing cash and one child is running the business and hoarding the money, or another child is they start to use this as manipulation if it's not thought out and very clear. And again, it may not happen in your lifetime, but are you setting the stage for them to get along in the future? And how do you create from a valuation standpoint that, maybe the building is worth $1 million and the land, and maybe the business is worth $1 million? Is that and then they have to work together. So they have a lease. somebody's earning income over here. It's deductible in the business. You have a tax advantage. There's management payments and things like that. Like, how do you create it so that you're not just paying the IRS for all of these situations, but it's mutually beneficial? Or like the trust, like we're seeing multiple trusts as opposed to one major trust that has ownership in all of these entities that is split between the siblings. Like, you can move these assets into a primary trust for each child or grandchildren, if you will. Sometimes you want the legacy. The other thing, though, is that gifting, because my other life is in the divorce arena, gifting these assets, I think, is tremendous protection for family wealth to transfer and still protecting it in the family from spouses, right? Because you don't want to be like, well, I'm concerned about your spouse, and again, you could write, like most people in high net worth families have prenups and things like that. But I've seen a lot of families that sell the business to the next generation. And by the sheer fact that they're paying for the business, it becomes a marital asset, whereas if it's gifted, those shares kind of remain in a separate container, which does protect them in a divorce situation, or at least better than other modalities. So you have to figure out, if I transfer it, if I gift it, how do I still get that income coming back to me in the form of a management agreement or a consulting agreement or an employment agreement? Because then I can still have health insurance. Like, these are ways that if you have the full team in play, you can execute this plan that's not only beneficial for you, but does all of the protections that I think that really families are wanting. Like, at some point, they're not as concerned about the wealth and the money. They're concerned about these protecting the family unit. Like right now we're in Operation Melissa's going to Save Christmas with a family. And, it really is, at the end of the day, they're like, these business decisions are ruining our family dynamic, right? And so how, like maybe as a parting thought, how do you kind of come in and maybe help? Because as a financial advisor, you are the center of understanding this family dynamic far more than any other professional in the accountability team. So maybe we should talk a little bit about how you deal with some of that dynamic personally in your own practice. And I'm going to show some ways that people can contact you as well. But that's the biggest issue that I'm seeing in this family wealth transfer.
Yeah, I think anytime you bring to a business owner's attention how much they may pay in taxes when things are sold or they pass, I think that's the number one thing that I can get that will get their attention no matter what. And then I say, by the way, here are the steps we can help it, whether it is with the portfolio and the trust, with that estate planner. There are some states, Illinois is not one of them, but Pennsylvania, where we have some clients who own businesses, there's an inheritance tax. So again, you want to be mindful of passing things on to the next generation, because 15% off the top is gone. Right. So if there's ways we can protect or minimize that as much as possible within obviously the legal limits, we want to do that. And that's true for everything, right? Whether it's selling the business, whether it's signing with a portfolio, we want to help you minimize, but it takes planning to do that. You can't just say, hey, look, I don't want to pay taxes. Great. It's, well, we want to minimize taxes. What's the best structure to do that going forward, both today and going forward?
Yeah, absolutely. And you have a firm that you are a financial advisor, and we have been working very closely with financial advisors for quite a long time in a lot of the estate planning, because we come in and provide really low cost valuation analysis. Because in the strategic planning phases, you don't necessarily need a full report until you're going to actually gift, until you're going, and even if you're going to go sell, I would encourage you not to have these reports in your files, because due diligence is going to say, hey, the buyer's going to say, hey, can I have all the reports that you've done for the past several years? Well, obviously, those are not strategically aligned. Those are not showing your best foot forward. It's almost like, fair market value. It's sort of like your minimum value that you need to prove up to the IRS. So in some of these capacities, I think that the planning and working with your financial advisor in connecting with the right valuation people, connecting with, maybe you're only compiling maybe you only have like your accountant that's been with you for 30 years is not doing a lot. Like you might want to step up and get an audit or a compiled or financial statements. You might want to start not running all of your personal expenses through the business and allowing it to be more transparent, but they can reach out to you. Is most of your portfolio business owners, or what type of clients do you normally deal with?
Yeah, business owners, small doctors who own small practices, those sorts of things. So a different sort of family-run business, because sometimes children's of dentists come in, take over the practice, same sort of thing. So a lot of similarities, but more specific. But business owners who have built their business in and around the country, who are looking and saying, am I ready to sell? Do I want to sell? Is it to the children? Is it not to the children? And then those conversations, sometimes we're talking to people 5 or 10 years before the end decision is made, and we're happy to work with them during that entire time.
Yeah, absolutely. Well, I think this was a great conversation. I think that, it's not here to show that there are these issues going forward. It's really if you're proactive and having some, estate planning or being prepared for that exit. When a buyer comes knocking, that's going to be the easiest transition you have. But there's a lot of negotiation around that deal. And that's where we step in as well to help negotiate those deals. But it takes a team. Be transparent with your advisor and your team of eventually I'm going to sell and I need some help having these discussions. I think that would be a great situation. So we appreciate you, Jeff, for being on the podcast. And, if there's another topic that you think is relevant, we'd love to have you back. And we will see you soon.
Great. Thank you so much for having me.